So now you are at the crossroads. You know that you must take control of your money and your overall financial situation. You have reviewed your finance, you know exactly how much your estate is worth, you have done your budget and set your financial goals, you know what investment strategies are best to improve your tax position, your income, your government benefits. You have figured out if investing in super, outside of super, or combination is the best way to reach your financial goals. So now is the time to decide on your investing strategy. But before you jump into making any investment decisions, you need to understand the investment risk, which is an essential step in developing your investment plan. And this is what we are talking about today. What actually is investment risk and why it is so important to understand it before you start investing. My name is Katherine Isbrandt from About Retirement. I'm a certified financial planner and you are watching About Retirement TV, the place to get all the information you need to learn about money, investing, saving in order to be well prepared for your retirement or to improve your retirement if you are already there. In financial terms, risk is that the outcome of your investment might be different to what you set out to achieve or what investment return you expect to receive. Talking about the rate of return, there is a close relationship between risk and return. As a general rule, the higher the expected return on investment, the higher the risk. And then the opposite is true as well. The lower the expected return, the lower the risk. Lower risk means the returns are more stable and there is a lower chance you could lose money. This is a great graph that I found on ASIC website that clearly explains the relationship between investment risk and reward. The vertical line shows us the level of return, while the horizontal the level of risk. As you can see on the graph, the lowest risk is when your money is invested in cash, but at the same time, this is where you get the lowest return. Check how much your bank is paying you today for keeping money in your saving account or in your deeming account or even in your term deposit. Close to nothing, I'm guessing, but there is also a very little chance of losing that money. So if you want a return that is greater than cash, you need to climb up that vertical line. And as you can see, we have no choice but to increase the risk by investing through fixed interest, property, shares, and alternative investments. Unfortunately, there are no investments that will provide high returns at low risk. But do you know what the biggest financial risk is? The biggest risk of all is not investing at all. Keeping your money in cash long term is a sure way to never get ahead, as your money cannot even keep up with inflation. We will discuss this in more detail in another video. So now that you know what investment risk is, you need to figure out your own risk tolerance. Your risk tolerance is your ability to cope with falls in the value of your investment, so the risk level you are willing to take to reach your financial goals. There are many factors that influence your risk tolerance. For example, your age, your capacity to recover from financial loss, such as investment time frame, ability to save, reliance on your existing capital. Also your financial goals, your health, and your knowledge and investing experience. When I see clients who ask me to assist them with investing decisions or creating an investment portfolio, I need to understand each person's risk tolerance. And to do this, every person needs to answer a number of questions that in combination will give me a very clear indication as to each person's risk tolerance. But how do you figure this one out by yourself? Well, one of the ways is to ask yourself, What would I do if the value of my investment dropped by 20% tomorrow? How would I feel? How much would that worry me? What would my reaction be? If you are unsure, go back in time only 2 years ago, March 2020, beginning of COVID, when markets across the globe reacted severely to terrible news with incredible losses basically within days. Do you remember what happened to your superannuation savings? How much did your super reduce in value? What did you do then? Did you panic? Did you sell all your investments and hide money in cash? Or did you decide to wait it out, knowing that markets recover over time, that those market movements are just part of the deal? Or maybe you took advantage of those falls and you invested more money. As you can see, each person can react differently, but if you analyze your past reaction, this will give you a very good indication as to the level of risk that you are willing to take, and you will understand your risk tolerance. If such drops cause a great deal of worry that you decide to withdraw your money, you really should keep your savings in a very low risk assets. But as a consequence, unfortunately, don't expect high level of returns. As I said before, there is no such thing as investments that provide high returns with low risk. Another question that you can ask yourself is, what is more important? Having a comfortable, low volatility and low risk returns, although there is a very high probability of not reaching your goals, or reaching your goals is much more important, even if that means some volatility along the way. If your answer is, I don't want any investments to be volatile, it worries me to see returns going up and down, so I'd rather not reach my goals than to go through those volatile returns, well, it tells you that you are a very conservative investor. If, on the other hand, reaching your financial goals that are really your life goals is more important than going through market volatility over shorter terms, and you know you don't panic, you don't participate in mad selling when markets drop, but you patiently wait for market recovery, or you do your research and your due diligence to confirm if your portfolio needs to be adjusted in any particular way due to those market changes, then your risk tolerance can be much greater, and you can create an investment portfolio according with that risk profile in mind, with much higher exposure to assets which are of higher risk but provide a higher returns over longer term. The emotional drama in most cases comes from lack of understanding and lack of experience. The more you understand investing and market behavior, the higher the risk you are willing to take. The truth is that smart investing is not about taking crazy risks. On the contrary, it is all about risk mitigation, correct diversification, sufficient research, consistency of ongoing review, and necessary adjustments to your investment plan. There is not one person on this planet that can avoid negative returns, which are part of your investing experience. But there are plenty of ways to reduce a degree of risk taken to reach your goals. So read books, learn from professionals, or ask for advice to assist you in understanding your risk tolerance, to build an investment portfolio that is designed to reach all those life goals that you dream about, and to have an ongoing advice and support to make those investment adjustments when necessary. I hope you enjoyed our today's discussion about investment risk. If so, please like this video and share it with your family and with your friends, and subscribe to this channel not to miss my next video. If you would like to get more information about investing, especially if you are preparing for retirement or if you have already retired, visit my website aboutretirement.com.au, where you will find lots of relevant information how to improve your financial efforts. Now now check out those videos. The first lot is all about the second biggest asset we have, superannuation, and how to take advantage of all super benefits. The second lot is for you if you have already retired and would like to improve your income, especially your age pension benefits. I will see you in my next video. Bye.